Hello, my name is Joe Hoyle speaking to you from the University of Richmond here in Richmond, Virginia. Welcome back to another of our videos. This one is about stockholders' equity. You've gone through a lot of chapters in our financial accounting textbook. You've learned a lot about assets and liabilities. In this chapter, we look at a number of different topics about stockholders' equity. A lot of terminology here and some accounting to indicate what is going on when you record these transactions. As always, I hope you've taken time to pick out your top 5 things in this chapter. There are a lot of things here that I thought were worth knowing. So, what did you pick? What did you think were the 5 most important? I've made my list and I'm ready to get started. As always, here's number 5. I thought, when I read this chapter, that the 5th most important thing was the fact that when you account for these stockholders' equity accounts, common stock, preferred stock, treasury stock, dividends, and the like, that there is no net income effect. You do not increase or decrease income as a result of stock transactions when it's your own stock. These are transactions between the company and its ownership. They are putting money into the business or, in some cases, taking money out of the business. But this is different than a transaction to generate revenues. This is different than a sale of a good or service. So although we accounted for a lot of things that took place here in this chapter, we never had an income effect. When you're dealing in your own stock, you do not report a change in net income. Let's move now to number 4. I found that treasury stock transactions were the 4th most important thing. The reason being that there was a lot of interesting information. Why do companies buy their own stock back? And we saw several reasons in this chapter, but one of the most common is the fact that companies often buy their own stock back hoping to give a boost to the stock price. That the increase in demand and coincidentally, the decrease of the supply of stock on the market will help the shares gain in value on the stock market. We also looked here with treasury stock at how they're accounted for. Initially, they're recorded at cost, and that shows up as a negative in stockholders' equity. It's a negative because the money left the company. It can't be a positive because no money came into the company. The company spent its money for this purpose. Many companies do buy treasury stock back and do it for many reasons. Therefore, I wanted you to know what the term meant and how it was accounted for. When I made my list, I put that at number 4. Moving to number 3. I thought that all of the information about dividends was quite interesting, both the cash dividends and the stock dividends. With cash dividends, you had several dates to learn. The date of declaration, when the board of directors makes the approval, the dividend date of record, when you have to own the stock to get the dividend, and the date of distribution, when the payment is made. I also found it very interesting to read about stock dividends. Companies issue stock dividends primarily to bring the price of the stock down. Typically, when you see that a stock dividend has been issued, it means that the company's stock has done very well, and it may have gotten so high in price that people have stopped buying it as much. To get more interest on the market, the company will try to bring the price down, and they do that through a stock dividend. Stock dividends are recorded as either small, which means that the retained earnings is reduced for the fair market value, or large, which means that retained earnings is reduced by par value. A small stock dividend is anything 20% or below. A large stock dividend is anything 25% or above. In the interim, between 20 and 25, you can account for it either way. Many companies, in fact most companies, pay dividends in one fashion or another. I wanted you to know about those dividends, and that, for me, on my list, was number 3. Moving now to number 2. We all hear about stock transactions. You can hardly pick up a paper, watch the television, look at the internet without hearing something about stocks. This chapter describes both common stock and preferred stock. All corporations have common stock. The rights that they receive are set by the state of incorporation. Typically, though, those rights are pretty limited. You can vote for certain things, usually the board of directors, and if a dividend is paid, you get your share of that dividend. Common stock has fairly limited rights. However, they are the owners, so if the company gets bigger, the price of the stock goes up. In about 10-15% of the time, companies also have preferred stock. Preferred stock is different. Its rights will vary considerably because its rights are set by the contract. Often, companies will issue preferred stocks that give a very set amount of dividend and in some way place it ahead of the common stock. A company, for example, might issue preferred stock and say that $4 per share will be paid each year, and that money will be paid before common stock gets any dividend. I think because these two terms are seen so often in the business world that you really ought to know the difference in common stock and preferred stock. I place that on my list at number 2. And as always, that brings us to number 1. Here I had no problem. In this chapter, I felt by far the most important thing was the determination of earnings per share. This is a number that everyone talks about. This is a number that everyone tries to guess. This is a number that really is valuable in looking at a company and its financial health. The computation that we went over was basic earnings per share. For basic earnings per share, you take the net income, you subtract out the preferred stock dividends, and that the number that's left, which is the amount of income for the common stockholders, is divided by the weighted average number of outstanding shares of common stock. Not a terribly difficult computation, but it's certainly one that really is looked at in the business world. It almost is impossible to think of another number in a set of financial statements that is more studied than earnings per share. We also at the same time looked at diluted earnings per share, which is the basic earnings per share with some adjustments. What are those adjustments? You take anything that can be converted into common stock and you assume it was converted. In that way, you show what the impact would be on the company and its income if those things were actually converted into common stock. All companies that are publicly traded report basic earnings per share. Any company that's publicly traded and has convertibles also reports diluted earnings per share. Now, to me, those 5 things are all very important. When you graduate from college, you want to know how the world works. Such things as common stock, stock dividends, cash dividends, basic earnings per share are just a fundamental part of the way the business works. I hope you've studied hard. I hope you're learning much. I hope your financial accounting course is going to be an A+. Take care.